If you've been following the economic news, you may have heard we're in a per capita recession. What does that mean? Should you be worried? What's going to happen? Well, in today's Property Insider video, Dr. Andrew Wilson and I discuss that. We talk about what's happening to interest rates, when or if they may be coming down. We're also going to talk about the latest economic data and figures, including savings ratios. So if you want to keep up to date with these macroeconomic factors that are affecting our housing markets, please subscribe to this YouTube channel and click the little bell icon so we can update you each time a new show comes out. It looks like Governor Philip Lowe will be able to exit quietly as the Reserve Bank has again left the cash rate at 4.1% last week after announcing no change to interest rates for the third meeting in a row, actually for the fourth time this year. So is this the end of interest rate hikes? And if so, when will we see interest rate cuts? That's what I want to ask Dr. Andrew Wilson, Chief Economist of My Housing Market. And I'd also like his thoughts on some of the other economic news that's come out this week. Hi, Andrew.
Yeah, good day, Michael. And another month, another pause.
Yes, there was. There was no change in interest rates now for the third month in a row. Media's having a fun time at the moment, predicting what's going to happen to interest rates in the future and talking about when we could expect interest rate cuts, Andrew.
Well, Michael, yes, the media, it's always exciting to read what's the latest, the flavour of the month in terms of where interest rates are going and why. And it's interesting to see just how it changes so drastically from month to month or quarter to quarter. But, you know, it's all about chasing headlines. It does get a little boring, the 24-hour or 24-second news cycle. But we did have rates on hold again over September. The interesting thing is, Michael, that probably there was the first time that we had some justification for rates being on hold. We're certainly not out of the woods in terms of inflation. In fact, Australia's inflation position is probably a little worse than other similar economies, US and UK, well, maybe not the UK, but the Eurozone, but certainly the US is performing better on inflation than we are and other economic factors as well. But yeah, on hold, third month in a row, fourth month out of 5 months. Have we seen the end of interest rate increases? Well, you know, we still have some work to do on inflation. Inflation, as we discussed last week, underlying inflation is still just a tick under 6%. Of course, the target range is 2 to 3%. The Reserve Bank says, yeah, okay, we're a way off that at the moment, but we believe that we'll get there by the end of 2025. Well, that's 2 years away, and we're already seeing problems with real wages. Inflation at that 6% level is certainly well ahead of annual wages growth, which the latest data from the ABS tells us is tracking at just over 3.5%. And the GDP numbers, which came out last week, reflect the fact that we are starting to struggle a little bit with higher interest rates, even though our economy is still generally performing well. And as I mentioned, Michael, probably for the first time, the pause can reflect perhaps some easing in economic activity. Of course, we saw with the latest labour market data for August that unemployment rate increased to 3.7%. Of course, it has been a bit up and down like a yo-yo, bouncing between 3.5 and 3.7% for a number of months. And 3.7% is certainly nothing to be concerned about because it's still a near record low unemployment rate for the monthly survey. We also saw the number of jobs fall, the number of unemployed rise, and the participation rate fell. But as we've discussed here consistently, Michael, we do have to take some of these ABS statistics with a grain of salt, given the problems or the issues post-COVID with the seasonal adjustment model. So we can see that with those sort of up and down results from month to month that we've had on the main economic indicators over this year so far. So the labour market, yeah, had eased. So I guess that's the first point that the Reserve Bank can make. Oh, well, maybe interest rates are starting to work, even though the economy is still very, very strong, or the labour market is still very strong. We saw retail sales growth increase up by 0.5% over August, but again, it wasn't enough to offset the 0.8% fall we had the previous month. So the trend is certainly eased on retail sales, still growing the trend, but not growing as quickly as it was last year. So a flattening trend growth for retail sales.
It's actually interesting to see what people are spending on, and households definitely have cut back on discretionary spending, haven't they?
Well, this is all about higher interest rates, higher mortgage payments to be made, Michael. No surprise there. This is the plan. You know, we need to cut spending to reduce inflation. I mean, this is economics 101, and it's working. But, we've increased interest rates 12 times since May last year, Michael, starting from zero and now up over 4%. So you would have expected to see some result. And really, we have seen no clear result in terms of speaking of the media, some of the predictions the media made. And we really shouldn't even be referring to this nonsense anymore in regard to sharp falls in economic activity in the shorter term. And when we talk about the latest GDP numbers, we'll once again see that Australia's economy continues to grow. But retail sales, that was another factor that the Reserve Bank can point to, the trend easing in terms of a pause, that interest rates may be working and they still want to have the wait and see approach. And of course, the latest inflation data was an improvement. We saw underlying inflation fall below 6% and headline inflation also fell again. Again, the drop in headline inflation is mainly about the price of oil, which is still lower than where it was a year ago. And that's why we're seeing declines in headline inflation. Not just here, but the US are experiencing the same outcome as well. So we don't want to start popping the champagne corks just yet, Michael, because it is basically about falling price of oil compared to a year ago. But the grey clouds are starting to gather on the horizon in terms of oil, because we're now starting to see oil pushing up over $90 US a barrel, which is a little concerning. And of course, we can see that at the Bowser with higher petrol costs, which are being exacerbated by the falling Australian dollar, which is all about our position against the US in terms of interest rates. It's sucking capital into the US markets away from Australia. So that just makes our imports even more expensive. So even though inflation is trending downwards, it is really still a factor of reflecting the readjustment post-COVID to those supply roadblocks that we did have. So we've got the case there for the Reserve Bank to say, yep, another pause. Interest rates look to have started to work, perhaps, but still some work to do, I think. And, even though we can be still a little circumspect about the implications for interest rates and where they're going, it is still just really more good news for mortgagees. And of course, the spring housing market, that we don't have more increases in interest rates coming along. We haven't had them for 3 months. But as far as interest rate cuts are concerned, I mean, again, this is just the roller coaster ride of the media, going from, we're going to have rises to we're going to have cuts, just to attract some sort of clickbait and attention. The only reason surely the Reserve Bank would cut rates is if we started to get into financial trouble. If we started cutting rates now, you could just imagine what it would do to the Aussie dollar, which would, in my opinion, start to free fall downwards. So just some really silly predictions there, or forecasts perhaps of cutting rates. And we've got to remember, rates are still below where they were at their previous peak in 2012. So that's the interest rate story, Michael. Quite lengthy there.
Let's talk about our economy then, Andrew, because that's measured by the GDP. And GDP is the monetary value of the final goods and services that are produced in the country over a given time. And the quarterly GDP came in at 0.4% for the June quarter. And it's actually been showing that our economy is still growing, but not as fast. But it's also given the media the ability to come up with another great headline. They're asking, are we in a capita recession? I mean, the Reserve Bank's got what it wanted. The economy is growing, but more slowly. But it's growing because of population growth. In other words, there's more of a spending, and partly due to government spending. So should I be worried? Are we in a recession like the media is telling me?
It's just like, if we can't get a real recession, we're going to make one up, right? So we haven't got a real recession in terms of GDP falling over.
Because it's growing as opposed to receding.
Yeah, that's right. So we'll forget about that. That's not a good story. Let's go with another story, which is GDP per head of population, all right? So we'll work that one. And let's have a look at the data. Oh my God, we've had another quarter of negative growth per head of population, per capita, GDP per head of population. So, isn't this terrible? Yes, it's terrible. We're in a recession and we have 3.7% unemployed. So, let's go back to the other real recession. In fact, the only real recession we've probably had, which was in the early 90s, when we did get consecutive quarters of GDP growth and we had 11% unemployed. 11% then, 3.7% now. And we know things are tougher now, and they have to be tougher with higher interest rates. But, I think we're knocking people over with a feather with this recession sort of per capita scenario. The reason we've had a recession per capita, Michael, over this quarter is because we've had an unprecedented surge in population. That's the whole point, because we closed our borders. Now we've opened our borders. So we've gone from zero to hundreds of thousands. So, of course, this has an impact on GDP per capita because we've had an unprecedented flood of people coming into Australia. It's like, okay, the headline, recession per capita. Well, what does it mean? Well, it means nothing, right? Because obviously, if we started to get into the realm of having negative quarters of GDP, overall GDP growth, then that would reflect a declining economy. But this is just a cheap story designed to generate clicks. But at the end of the day, it was a good result. And talking about the hysterical media reaction to our economic data, we don't have to look back too far, Michael, to see the predictions of a recession this year. What happened to that? We were going to have a real recession this year. Oh, it was almost a certainty. All the markets, whoever the pinheads in the markets are, had predicted that, but that bounces around like the weather, their predictions. And of course, it's the same in the US, where they had, consistent, almost, to certainty, we're going to have a recession in the US. And now they've all backpedaled on that as well. So poor, desperate financial journalists, commentators, whatever, are now pinning perhaps their livelihoods on a scary story about a per capita recession. I think the numbers were pretty good, Michael, for the GDP. We can sort of run through them if you like. GDP, as you said, increased 0.4% in the June quarter. Similar results over the last few quarters, up by 3.4% over the financial year. Steady results. It was the seventh straight rise in quarterly GDP. Annual growth remained above trend, and that reflects, of course, the absence of the COVID issues that disrupted our economy through previous years. Capital investment and exports of services were the main drivers of GDP over the quarter. A lot of spending going on with governments. And I think it's interesting, Michael, when we look at the GDP results, that they're actually pulled down by import-export relationship, which basically was a fall in the price of resources, which impacted Australia. So we had resource prices fall away during the quarter. These things have come from a high. And as the world economy re-establishes itself to some degree, of course, there's less demand for resources now post-COVID, but still, demand, and that's pushed prices down for a number of resources. That has affected Australia's result. So, as I said, if we had had higher resource prices, Michael, we would have had a better result. So it's not a bad result considering, and of course, we know how important the export sector, resource sector is to Australia, particularly for its GDP. I think that was, once again, a pretty fair result. The silly headlines about per capita GDP recession have just been, just another desperate attempt to attract attention to failing media enterprises, in my opinion.
To be fair, technically it's correct, but does it mean anything to you and me? Not really. The economy is weak because the Reserve Bank's created that, it's wanted to, but we're not going into the sort of recession people should be scared of. Having said that, the Australian Bureau of Statistics showed that household savings ratio continued to decline from 3.6 to 3.2, very different to a couple of years ago during COVID when we were able to stash our cash. I guess what it's suggesting is we're using up our savings to get on with life at the moment, Andrew.
Yeah, and just as you just following up your comment that the economy is weak, Michael, I'm not sure our economy can be described at any level as weak. This is one of the strongest economies Australia has ever experienced. If 3.7% unemployment rate is weak, give it to me every day of the week. Thank you very much. And this is an adjustment through the spendathon that we had through the COVID stimulus packages, which had to happen. And of course, we weren't going to continue with 0% interest rate over the longer term. And as I said, we're not even back to where we were at our previous cyclical peak, but just getting back to the impact of interest rates with interest rate pauses. And as you mentioned there, the household savings ratio fell again to 3.2% versus income, which is its lowest level since 2008. And of course, this is just an adjustment back following the huge savings outcomes that we had during COVID, because it was a giveaway of money. We put it all in the bank because obviously we're also wanting to secure our future in a critically uncertain environment. And now, of course, not only have we sort of normalising that, having spent, but of course higher interest rates mean that and higher prices mean that we have to delve into those savings. So yes, no surprise there, but this is what the Reserve Bank would be looking for to quell demand, is the fact that we don't have the savings that we had to spend, that we are spending them because we're having to survive in a higher interest rate, high inflation environment. So really no surprise there. And again, this would make the Reserve Bank feel comfortable about their pause decisions going forward. But of course, this is June quarter data, Michael. So we are looking backwards slightly. But I think the big picture is they were good results for the GDP. And given the considerations that we had not a good quarter for export prices, resource prices, there's really no sign of a recession anywhere there. And you can call it whatever you like, per capita GDP recession. But as I said, where's the impact other than with the statistical models?
I just wanted to remind you that this is not specific investment advice because we don't know your personal circumstances, but we're more than happy to have a chat to help you take advantage of this new property cycle. If you think about it, the opportunity like this to get set at the beginning of a new property cycle doesn't happen very often. So why not have an obligation-free chat with my team at Metropole to discuss your goals and to discuss your options. We're much more than just another buyer's agent. We help you safely create intergenerational wealth through property. We're big enough to tip the scales in your favour, but still small enough to care. And as we don't sell any properties, our advice is independent and unbiased. Now remember, property investment's a process, it's not an event, so you can't just go out and buy any property and hope to be successful. In fact, now more than ever, getting the right advice is critical. So if you're looking to invest in property or buy a new home, go to metropole.com.au and have a chat with our multi-award winning team. It's a great feeling having the team at Metropole on your side, levelling the playing field. Now it's the spring selling season and the auction markets tracked back a little bit on the weekend. It was a little bit of a surprise, Andrew.
Yes, Michael, it was a bit of a surprise. It's been, our auction markets have really been very consistent over winter, almost given the winter selling season is typically a distracted period of the year. Holidays, people start thinking more about a spring campaign, but the markets kept on keeping on. Auction volumes increased is what we usually see through August. We had year-to-date high numbers of auctions through August in Melbourne and Sydney, so plenty of stock there. So those commentators that were blaming low stock numbers on higher prices will have to rethink their analysis and or maybe go back to school, I don't know, because the markets continued to rise through August with clearance rates certainly well above 70% in most jurisdictions. But we did have a bit of a tracking backwards at the weekend, Michael. We had all of the weekend markets had lower clearance rates. Listings still remained elevated. We're comparing it to the previous weekend results. So we can tend to see as spring comes in some blips from weekend to weekend. We, of course, had the beginning of the football finals this weekend. I'm not suggesting that would have worked its way into, because obviously the listing numbers were still high, but perhaps it was a distraction for some buyers. But nonetheless, we are going to, over the next, certainly in a fortnight's time, we'll have our first spring Super Saturday of auctions, the pre-grand final weekend. That'll obviously be a big test for the market. Its first big test of spring is that Super Saturday, pre-grand final Super Saturday of auctions. And numbers are looking to be quite reasonable, forward-tracking auction numbers over the next couple of weekends. But these are early signs, perhaps. There's a little bit of buyer fatigue occurring in the market, but I wouldn't be calling it early days yet.
Andrew, 7 out of 10 properties in the big capital cities sold at auction, and we know others sell over the next couple of days or weeks as well. When you look at the smaller auction markets, that's not really as relevant. Brisbane's auction clearance rates were a little bit low, but it's really not an auction-oriented city. So 7 out of 10 sales isn't bad to me.
Yes, and we're coming again for Melbourne. It was year-to-date high number of listings. Sydney similarly close to year-high numbers of listings, down a little bit from the weekend before. And look, it's the lowest clearance rate Sydney's had since July, early July, which just shows you how strong that Sydney market's been performing. But, you know, we need to wait for a couple of weekends to see the outcome. But as I said, in a fortnight's time, we'll have the first Spring Super Saturday, and that'll really test the market because we'll have significantly higher volumes of property coming in. And in Melbourne particularly, and Sydney to a lesser degree, we'll have a much more significant volume of higher priced properties coming into the market. So that will test that particular group of sales.
You report the auction clearance results every Sunday morning on your LinkedIn profile. We report them as well. All your results and your report on property updates every Sunday will let people know. And we're going to catch up next week and have a talk about the rental markets. We didn't have a chance to talk about that today, Andrew.
And with the Brisbane numbers, there was a low number of properties came through that reported from Brisbane on the weekend, Michael. So that was some reason for the lower clearance rates and lower actual reported auctions, numbers of reported auctions. But there was a trend downwards, and we'll just wait and see whether it was just part of the wave of ups and downs that happened through the spring selling season. But we've got plenty of challenges coming up, so let's see how our markets can do over the next fortnight.
Look forward to catching up with you then. Thank you.
Thank you, Michael.